Howdy. Welcome back to Dion Talk. In today's video, I'm going to explain why I don't think that there's a crash coming in the real estate market. I understand that as an investor, most of us are hoping for a crash so that we can buy properties on sale. That's a real thing. A lot of the content providers will say that there's a crash coming because that is attractive to an investor, so they get a lot of clicks and a lot of video watches. The reason I don't think that there's going to be a crash is because everybody keeps referring to the 2008 crash and saying that they're seeing things that they saw then. Prices keep going up, eventually prices can't go up anymore, so there has to be a correction, and that's not actually accurate. Prices go up until people can't afford to go any higher. That doesn't mean they're going to come down. There's some things that we had in 2008 that we just don't have now. In 2006, 2007, 2005, you can do a ninja loan. No income, no job, just go into a bank and say, I will write down that I make $200,000 a year, so give me a loan. There were adjustable rate mortgages. People could get a loan where they can handle the payment, and in 2 to 4 years, the rate would be going up to an interest rate that they couldn't handle, expecting for there to be appreciation on their property and that they would just refinance. Properties didn't appreciate, so people didn't have equity, so they weren't able to refinance. And when the rates went up, they couldn't afford the payments. Foreclosures happened, short sales happened, there was a ton of inventory, the housing market just got flooded with a bunch of places for sale, so prices dropped. Now, lending is actually pretty difficult. You have to prove income. There's very, very few adjustable rate mortgages. There's no ninja loans that, from the traditional lenders. While prices are going up, it's a supply and demand thing. There is a large demand. A lot of people are making money. I understand that with the pandemic, we hear a lot of people are on unemployment. But statistically, there's a lower amount of people on unemployment right now than there was in 2010. So while people being on unemployment is not a good thing, the number is actually a lot smaller than what it seems like because it's all over the news. Now, I'm mostly talking about residential, single family, small multifamily, not 5 units or more, that's commercial. And someday I'm going to make a video as to why I focus on residential instead of commercial, but not today. And there's no supply, there's no inventory. Most places have 4 to 8 months of inventory in a regular year, but a lot of the markets right now have 1 to 2 months worth of inventory. And I mean, that's another aspect of this to think about. Everybody says the housing market is going to crash, like there's one market. There's almost 400 housing markets in the United States alone. And yes, there will be some of those markets that are impacted. Probably the 12 largest major cities, because over the last 20 to 30 years, cities have appreciated the most because people wanted to live in the cities where the work was. In the last year, we all learned that with the pandemic, working from home became an option to more people. And it's a lot more attractive to have a $1,500 mortgage living outside of a city because you can work from home than it is to pay $4,000 for an apartment inside a city. The larger cities like San Francisco, Los Angeles, New York, they're seeing a softening already in prices, but all of those people that are moving are going to the other areas, which is causing the demand to go up while there's still no supply, which is causing the prices to go up. And then a lot of people, like me last year, aren't looking at the interest rates. At the beginning of 2020, I bought a fourplex, and my interest rate was 4%. Interest rates dropped down. For an investor, I was able to get 3% interest rates later, but I was watching prices go up, and I was thinking that generally, I like to pay $150,000 per unit for a duplex. I bought the fourplex for $590,000, so that was a little bit less than $150,000 a unit, and I was able to cash flow. Prices went up, and I started seeing prices for small multifamily that were $160,000 a unit, $170,000. And I missed out on a bunch of deals until I looked at the math and I actually ran the numbers. And when I saw that with the lower interest rates, even buying a triplex at $175,000 a unit, I was paying less per month. So I picked one up in November. So last year, in the middle of a pandemic, when everybody was in this, I don't know what's going to happen, panic mode, I picked up 7 more units, which basically doubled the size of my portfolio. I'm looking now because prices are going to continue to go up because there is no supply. The demand is still there. And there are not as many of the indicators as there were in 2005, 6, and 7 that are going to cause a market crash. There are some markets that will be impacted. You might be in one of them. If you are in one of the ones that goes up to where it's too high for you to buy, you might start looking into distance investing. Even several years ago when I started looking for houses here in the Washington area, I was originally looking for single family houses, but there were so many people looking to buy houses that the prices went up so high that I couldn't buy them as investment properties and actually have any cash flow. So I switched over to small multifamily, and I realized that with small multifamily, I'm not able to hit the 1% rule, but I am able to get better than a 10% cash on cash return. Here's a simple example. Single family houses were going for $400,000 each, and the average rent for that house was about $1,800. Small multifamily, when I was paying about $150,000 a unit, a duplex would go for $300,000. The rents on each side would be $1,300 to $1,400, so we'll figure $2,600. That's not the 1% rule, but that's better than a 10% cash on cash return for me. So I picked up 3 duplexes paying about that amount. There are good deals out there. Interest rates right now are lower than they have been in decades, if ever. I'm not saying run out and buy any deal that you find, but I think if you're an investor, you shouldn't be just stockpiling cash waiting for a crash. You should be saving and stockpiling that cash, but looking at deals every day. If you're not looking at deals, you're not going to recognize a good one when it pops up. But if you're looking every day, you're going to recognize the ones, and I do look at a lot. I look at 20 to 30 before I find one that even takes a deeper look to figure out if I want to make an offer on it. And most times right now, because of the supply and demand scales being skewed, I make over 20 offers before I even get any kind of response from a selling agent. Anytime in history, just about, it has always seemed like it's a bad time to buy real estate because it's too expensive. But if you look back historically at almost the last 100, 200 years, anybody who bought properties 20 years ago looks like a genius. Think of this. In 2013, people saw prices start to recover because in 2010, 11, it was kind of at the bottom of the market, and they started to go back up. People thought, I'm going to store money and I'm going to wait for the correction. I'm going to wait for the crash. So since 2013, prices have been going up and people have been sitting on the sidelines missing out on 8 years of cash flow, appreciation, principal pay down, all of the tax benefits, waiting for that correction, waiting for that crash. I understand. When the topic comes up, a lot of people bring up forbearance with the pandemic in 2020 and the over 3 million people that have just chosen to not have to pay their mortgage for the next 6 months or year. But if we look at the timeline on that, even if somebody was actually impacted by COVID and had to take forbearance because they weren't working and didn't collect unemployment, didn't get the extra unemployment, and were just not able to make their payments, in worst case scenario, they were actually going to lose their house at the end of the foreclosure and eviction moratorium. That looks like the new administration is stretching it out to September, which it could get pushed out past that. And if it goes all the way till September, that starts the timeline for the foreclosure, which an average foreclosure in the faster states is 150 plus days. So 5 months from September, we're looking at 2022 by the time that the people who are going to possibly go through a foreclosure. And that doesn't mean that everybody on forbearance is going to. There are a lot of people, since there was no verification requirement to say that you were impacted by COVID to go on forbearance, people could just say, I don't want to pay anymore, and take that time to save that money. And it's not like at the end of forbearance that you have to come up with the 6 months or the 1 year, all the payments at once back to the lender. In the past, there's been times where people do that with forbearance, but the way it's set up this time is you're getting an additional zero interest loan added on to the end of your mortgage. Yes, you're accruing interest for the time you're on forbearance, but that money is set aside as an extra loan at the end. So the money that you ended up setting aside that you didn't pay during your forbearance period is set at the end of the mortgage. So the only way that you'd really end up paying that is if you paid your mortgage off or if you sold the property. Neither one of those are going to cause somebody to have to go through a foreclosure. And one of the really big differences between 2008 and now is in 2008, a lot of people didn't have equity. They lost so much of the value in their houses that the appreciation and principal paydown amount that they were counting on was gone. Now, prices keep appreciating. The demand is so high, the supply is so low, that people have equity in their house. So if they do reach the point of foreclosure, they're going to sell long before then, or they have other options. I hope I at least made you think. Look at the data before you make a decision. If you're more comfortable sitting on the sidelines, more power to you. But there are a lot of people who are going to be buying properties in 2021 that are going to make a lot of money off of that purchase. Please hit like, hit subscribe, share this video with a friend. Maybe somebody else needs to hear that the world is not coming to an end and the housing market crash is not right around the corner. Until the next video, thanks for coming to my Dion Talk.
We're sorry, the number you have dialed is not in service at this time.